you got bonds going up at the same time. See, bonds are normally the risk-off asset. Stocks are the risk-on asset. They're both up. And that is because everybody assumes the financial system is going to be flooded with money pretty soon. So it'll push down interest rates, push up stock prices, and let the good times roll. Now, of course, you and your listeners know that in the process of all this taking place, huge amounts of new debt will be taken on, because what low interest rates do is encourage people to borrow. So global debt to GDP is going to soar from here, and it's already at debilitating levels. We're already at a level of leverage that guarantees a monster crisis somewhere in the not too distant future. So what we're doing with all the central banks just easing when anything happens that spook the markets at all, is we're making that problem worse, and we're making the eventual consequence of all that debt much worse. So we don't know when it's going to be, but when it happens, it's going to be the financial crisis of our lifetimes.
Welcome back to Finance and Liberty and Reluctant Preppers. We're delighted to have this returning guest, John Rubino. He's been with us several times before. He is the author, together with Gold Money's James Turks, of The Money Bubble and several other books. John, thanks for joining us here again on Reluctant Preppers and Finance and Liberty.
Good to see you again, Dunnigan.
I wanted to mention that today is Monday, February 10th, 2020. We are back in the office. I had been away for a while and glad to be able to get back on the fresh interviews for our viewers, and they are always delighted to see those as well. You're always a well anticipated guest, and we've got several questions that have been submitted ahead of this interview. But before we get into that, you and I were just talking about this bizarre phenomenon that's occurring now in the financial world, and that is you phrased it as all news is good news, and I'd like you to get into that for us and explain what you meant by that.
Yeah, well, this is really a uniquely bizarre time in financial history. In that, the world's central banks are just sitting there ready to flood the system with cash and lower interest rates into negative territory on any bad news. So the markets are looking beyond the actual news. For instance, the coronavirus thing. And before that, our almost war with Iran. And maybe in the future, political turmoil. They see all this stuff happening, and in normal times, that would be bad for instance, stock prices, and maybe for bond prices, and definitely for real estate prices. But they're looking beyond the immediate problem to what central banks are going to do and focusing on that. So everybody's buying in anticipation of central bank easing, even when the news is bad. Like, look at the coronavirus thing. We don't know how this is going to turn out, but it has the feel of a disruptive event, right? I mean, if half of China is shut down, flights aren't taking people from country to country anymore, and a lot of supply chains have been disrupted by factories closing. Okay, so that's bad for the global economy, and in theory, bad for stock prices, because that means that corporate earnings won't be as high as they would be otherwise. And stocks are at record levels. Why? Because the investment community is looking at the disruptions from this virus and thinking, well, then now we'll get negative interest rates, and now we'll get QE, and now we'll get massive asset purchases beyond QE, and so they're thinking ahead to what the Fed will do in response to this, and deciding that it's a good reason to buy stuff. Meanwhile, you've got bonds going up at the same time. See, bonds are normally the risk-off asset. Stocks are the risk-on asset. They're both up. And that is because everybody assumes the financial system is going to be flooded with money pretty soon. So it'll push down interest rates, push up stock prices, and let the good times roll. Now, of course, you and your listeners know that in the process of all this taking place, huge amounts of new debt will be taken on, because what low interest rates do is encourage people to borrow. So global debt to GDP is going to soar from here, and it's already at debilitating levels. We're already at a level of leverage that guarantees a monster crisis somewhere in the not too distant future. So what we're doing with all the central banks just easing when anything happens that spook the markets at all, is we're making that problem worse, and we're making the eventual consequence of all that debt much worse. So we don't know when it's going to be, but when it happens, it's going to be the financial crisis of our lifetimes. And from a an economic geek standpoint, like which is my point of view, this is fascinating, and it's fun to watch from a safe distance. But for anybody who's caught up in it, nightmare time. It's going to be financially apocalyptic, and maybe just flat out apocalyptic. We'll see, but it's got the makings of a really bad decade. Something historians will be writing about for 100 years, and we're heading into it now. So here we are.
We had a guest on, Danielle DiMartino Booth, who is formerly part of the Federal Reserve, and she had a quote that she tweeted that said, "Central banks are printing cash. That is all you need to know." And it was about exactly what you were talking about,
Mm-hmm.
that no matter whether things go up or down, if they're stepping in, Gregor Manarino has referred to it as the Fed put underneath the market. That, in other words, no matter what, if people want to sell, don't worry, the Fed's going to step in as the buyer of last resort, so you're covered. So risk is on.
See, that is the shortest investment thesis in the history of finance, and one that everybody can buy into now. If you're managing money, you have to assume that a new or a huge amount of new money is going to be created, and some of it is going to flow into whatever you're buying. So it's a very easy life for somebody who's willing to trust the Fed. Um, and of course, you shouldn't trust the Fed, but the financial community has learned the lesson that you can trust central banks because they're always going to be at your back. So crazy times.
We have a question from a viewer, Yu Sinclair, who says, "How long does Mr. Rubino think China can be out of business due to the coronavirus before loans, derivatives, etc., default and their financial system collapses?"
Well, China quintupled their debt after the Great Recession, and that pulled the global economy out. That's why we had a recovery, basically, because China borrowed all this money. And a lot of that borrowing was by these kind of shadowy entities that aren't exactly banks. They're like special investment vehicles set up by cities and municipalities, and counties, their version of counties, and states, that borrowed a ton of money and bought a bunch of raw materials and built a bunch of infrastructure, much of which isn't generating anything like the cash flow that is necessary to pay off the debt. So there was a crisis coming regardless. And now, with a big chunk of China just flat out shut down because, coronavirus isn't the only thing they've got going, because they had that pig Ebola that wiped out half their pig population. And now they've got a bird flu variant that is also springing up and is also communicable. It is airborne. So they have a really serious problem with basically, overcrowding that is allowing these pathogens to enter the human ecosystem and spread. And yeah, I would say it doesn't matter how long China shut down because they already had a big crisis coming. But the longer they are shut down, the closer that crisis comes. So it might affect the timing. It won't affect the actual financial crisis because that was going to be big and brutal regardless. But it might make it this year instead of next year or something like that. So it is definitely something to pay attention to, but it doesn't affect the broad outline of the gigantic crisis that's coming. It just messes with the timing a little bit.
In a
And
perverse way, almost sooner rupture of the bubble might actually be merciful, in the sense of the, you mentioned earlier, this sort of this cataclysmic dimension of things that we've never seen, the world has never seen, the setup, the tensions that are present, the imbalances, the distortions that are present, almost sooner better than later, as far as minimizing the extremely corrosive effects of what is coming.
yeah, but the central banks of the world aren't going to let that happen, or they're going to try to stop it. And it's interesting and illuminating to examine exactly what it is they're trying to do, because we're 10 years into an expansion. The average economic expansion is about 6 years. So that means that this one is already really, really old. And because it's so old, it's got all these imbalances that are built up. And those imbalances are what leads to recessions. You get too much subprime debt. You get bank balance sheets and corporate balance sheets over leveraged. Things like that happen late in cycles and cause the slowdown that wipes out the debt in a healthy way and lets the economy start over. Well, we're way, way into that process of building up imbalances. And now the central banks are going to try to short circuit the normal process of debt being wiped out and the system cleansing itself and being able to start over by just igniting a new expansion before the recession comes to cleanse the old expansion. And that's another thing we're doing that is really unique in financial history. And because of that, it's fascinating because it's an experiment. It's fun to try this. You can't normally experiment on human beings, right? Because
Not
if it doesn't
ethically.
work out, yeah, not ethically. So there are all these things that people would love to know, but the only way to find out is to risk hurting a bunch of people or killing a bunch of people. In finance, one of the big questions is, can you just do away with the business cycle by creating enough new currency to prevent recessions from happening? And that wasn't something that anybody wanted to try because of the perceived bad effects of creating all that new currency. It would have been inflationary. It would have crushed the value of the currencies of the countries that were trying it. It would have led to a lot of debilitating debt that people shouldn't have taken on, but did. Um, so it never got tried. But now we're just, we're leaving aside our concern for all the potential problems and just going for it. And I have such mixed feelings about it because it's an experiment that is fun to contemplate, and it's going to be interesting to see how it plays out. But I can virtually guarantee you, that it will end up hurting hundreds of millions of people around the world. So it's going to be an experiment that fails catastrophically, but it looks like they're going to run it anyhow. We're going to find out that you shouldn't do this stuff. Even though common sense already tells us we shouldn't do it, we're going to try it for real and find out for real. And I think it's stupid, and the people who are doing it will be seen as historical villains when they finally get around to writing accounts of these times. But that's not stopping them. We are going to try this, and I'll be happy to sketch out some of the probable
Yeah, I was
consequences.
going to say let's play that out a little bit because we may be unable to dramatically influence the course of actions by people who are in the decision-making power. Okay, but we can use common sense to predict with some rationality what are likely to be the impacts on ordinary people and try to minimize the damage on the individual level. So
Well, hence prepping. That's what you do in a world where you can't affect the outcomes at a macro level. We can't stop this from happening because the guys in charge are going to do it. So all that's left is for us as individuals to try to figure out how to protect ourselves and our families. Um, so let's look at some of the consequences of just letting it all hang out at the central bank level and creating as much new currency as it takes to stop a recession that really has to happen, and making interest rates negative with all the negative consequences that implies. Let's say we do that and see what happens. And what will probably happen is that you get even more debt. You're encouraging people with negative interest rates to borrow money. And I might be one of them. If somebody offers me negative 1% on a mortgage, I'm going to feel obligated to buy a house just because it's the high point of a finance guy's life to be able to borrow money at negative rates. It's just something that you dream about. So when you have a chance to do it, you kind of have to do it. But a lot of people who really, really shouldn't do it will do it. So you create a lot of bad debt, which will blow up and cause even easier money. So this is a process that goes on as long as the currencies that these central banks are using to manipulate markets retain value. But at some point, people figure out that, oh yeah, there's three times as many dollars this year as there was 5 years ago. What does that mean? Shouldn't the dollar be worth one third as much? And maybe I'll treat it that way by selling dollars in order to buy real stuff. So probably what we'll see is a plunge in value of the major currencies, the ones that are being used by central banks to manipulate their
And
economy.
out of fairness, you mean an acceleration in the plunge of values of
Yeah.
major currencies?
I mean, they're not plunging now. They're declining at an orderly pace of 5 or 6%. Forget about the CPI. That's a made up number. But if you include, stock prices, bond prices, real estate prices, in other words, financial asset prices in the CPI, in the measure of inflation, you get 3 or 4 or 5% increases. Um, and that's kind of the rate at which the dollar is deteriorating now, depreciating. But once people lose faith in the currency and start acting the way I described, you get kind of a waterfall decline or off the table drop, something like that, where it's going along, dropping by 5 or 6% a year. And then boom, all of a sudden, the price of a lot of things out there are up by 30, 40, 50, 60%, which is the same thing as saying the dollar fell by that amount versus those things. And that's when it becomes disorderly. In other words, uncontrollable. And so that's what you want to prepare for. It's easy to prepare for 3 or 4% inflation because you can own a house and that protects you from it, or you can own some gold and silver coins, just a few, or some stocks of companies with pricing power, and you can borrow money and see your payments get smaller in real terms year after year. So that there's a lot of obvious things you can do. Um, when you've got an orderly decline in your currency. But when it falls off the table, that is a tougher proposition because you definitely want gold and silver in that kind of a situation because the currencies will fall off the table versus old forms of money like gold and silver. So they will be the things that go up by the 50, 60, 70% a year when the currencies start crashing. So you totally definitely want to do that, but you want to do it in a bigger way than you would now. You should have maybe 10% of your capital in precious metals in a world where there's a regular, steady, orderly decline in the currency. But when it's a chaotic decline, then you might as well have everything in gold and silver. So that's the difference. It's a kind of a step function where you'll do something here and you'll do something orders of magnitude more extreme if you're on top of things, if you're correctly anticipating the end game here. and and then there's the question of whether you should borrow money in that kind of a situation because it makes intuitive sense, right? To owe as much money as possible if the currency that you're paying that debt back in goes down in value. That's a trickier one though because one, you need to be able to make those payments regardless because if you can't make your payments because you lose your job or because the economic disruption messes you up in some other way, then you lose everything. You lose all the stuff that you bought with that debt. And governments may not let that happen. They may not allow debts to be wiped out in this kind of a currency disruption. So they might just rewrite contracts. So your debts are revalued according to some measure of inflation. So if the dollar drops by 20%, your debt grows by 20%. So your payments in real terms stay the same. And you don't want that. That's not a good outcome to that investment thesis. So that's a dangerous thing. I wouldn't advise doing it. It's better to go debt free and then use what capital is left to get away from the currency in which you're operating, and get into things like gold and silver and really, really well chosen, paid for with cash real estate, stuff like that, and maybe energy assets. The list of real assets isn't extremely long, but there are 5 or 6 or 7 things that you could buy that would probably do well in a world where the currency is losing value at an accelerating rate. And that's how you want to structure your finances when something like this starts. And so then it becomes a question of timing. How do you know ahead of time when it's going to happen? Jim Rickards has a little story that he tells about how he talks about currency crises and gold going up and everything, and people say, "Well, I get that, Jim. So tell me the day before it's going to happen, and I'll move all my money into gold." And he says, "No, if I knew the day before it would happen, then I'd be on a yacht somewhere." So you can't know exactly how all this plays out in terms of timing. And that's the tricky part because you don't want to be in the steady, orderly decline in the dollar kind of portfolio when the unruly, chaotic decline begins. You want to move over before that and take the risk of being kind of sort of in the wrong place for a year or two because the alternative is just being totally passed by this thing by not being able to make those moves when the time comes.
Speaking of, you mentioned whether people should consider, and governments certainly are, and businesses are, increasing debt as a tool for these current times that we're in. And student debt is one of those things that's been a record, hitting records and affecting a record number and percentage of the population as well. I have a question from a Google user who says, what does John think the probability is for student loan relief this year? There is a bill in the House, a bill in the Senate. The Trump administration has the Department of Education taking public comment regarding loosening the undue hardship requirement.
Well, I mean, I'd go a lot further than that. There's a chance that they just pay off all the student debt in the next few years. If we elected Bernie Sanders, that would be one of the first things he does. And, it's funny because neither of my kids have ever taken out a student loan. They're both college age. And because I've always told them it's a terrible idea to borrow money for college. We'll pay your way through. It's okay, and you guys be frugal about it, and we'll take care of it. But just this last year, I started telling them both, what, maybe you should borrow some money to pay for the rest of college because they might just pay it off for you. And if the government changes and the Democrats take over, there's a decent chance that one of the things they do will be just to pay off everybody's student loans. And in that case, the kids and the families of the kids who worked hard through college with second jobs and who never borrowed money, who just managed it because it was their responsibility, they're the ones who are hurt by this because all that work that they did turned out to be for nothing. And at the same time, the government has to borrow the money that it uses to give whatever kind of student loan relief that it gives. So that increases the debts that we all owe via the federal government. And there's a decent chance we see that. And there's a decent chance we see the same thing happening in, part of the mortgage market and the auto loan market and the corporate debt market, where they just start bailing out everybody in sight because they can't allow any major sector of the economy to fail, because that would cause a recession. And a recession would cause maybe a catastrophic failure of the whole financial system. So they can't let that happen. So yeah, to get back to student loans, there's a very good chance that they'll do something to help student borrowers. And I don't know what that'll be, but there will be a trend in that direction over the next few years. Because if, let's say, Donald Trump is reelected and he chooses not to do much of anything about student loans, that creates a market for a politician who comes along next and promise to do something big for student loans. One way or another, we're going to be bailing out everybody in sight, and student borrowers will be among the ones who are bailed out.
Another big concern is pension plans. You mentioned earlier China having these sort of municipal and regional things. Well, we've got in the U.S., we've got both metropolitan areas as well as entire states. We've got private pension plans of companies and things like that are underfunded. And let's go back and play your mind thought experiment that you were proposing earlier of what if the powers that be just keep on doing what they seem to be determined to keep on doing and bailing everything out as we're seeing. How does that affect all of these underfunded pension plans, both due to interest rate dropping, that kind of thing, with how their investment plans aren't working out the way they thought they would, et cetera?
Well, pension plans are one of the victims of the strategy that the Fed and the other central banks have adopted, because plans have to invest a big part of their assets in fixed income. And generally, they need 7% returns on their investments in total each year in order to be able to pay off their beneficiaries when the time comes. Now, central bank or pension funds have been unable to do this for a long time. So some of them are wildly underfunded. They're borderline bankrupt already. And because they have a lot of money invested in bonds, which are fixed income, which depend on interest rates, when the governments of the world cut interest rates even further and maybe make some interest rates negative, pension funds can't generate any returns on that part of their portfolio, and makes it even harder for them to generate the returns overall that they need, makes them even more underfunded, brings them closer to bankruptcy. And so in the next cycle, they will also have to be bailed out. So you'll see, Chicago's public sector union pension funds just go flat out broke. They will just not be able to pay their bills in the near future. And if the federal government lets that happen, you have this massive crisis in Chicago, which becomes a massive crisis in Illinois, which becomes a massive crisis in the muni bond market across the country, et cetera. It's just metastasizes. So they will have to step in with our money, with taxpayer money, bail out Chicago's teachers and cops and firefighters. Um, and that's just Chicago. The same problem exists everywhere. California, New York, Kentucky, New Jersey, Connecticut, all of these guys have huge pension problems. And when they start to blow up, will each threaten the other. In other words, they'll be dominoes that knock each other down and force the government to step in. So, that's the story of the next few years, is bailouts everywhere you look. And that's part of why central banks are doing what they are doing, because they know that, they know that if anything goes bust, everything could go bust. So they are taking extraordinary measures to keep anything from going bust here. And that's just the US. Deutsche Bank's derivatives book is outrageous. They could go bankrupt at any time. And Italy, and possibly France, and possibly Spain. The European Union has a lot of financial issues that they're not addressing, and because of that are only getting worse. And so they could be the epicenter of the next crisis. And so could Japan, so could China, so could it could happen anywhere. And once it happens anywhere, the risk is that it spreads everywhere.
You're talking about the Fed as an example, maybe the largest of these buyers of last resort, that's just basically going to try to whack-a-mole wherever there's a problem, just paper over it with fiat currency as the solution. We have a question from Irish AJW2, who kind of tries to pick on that scab of what the meaning of the debt and the interest that's due on the debt and that sort of thing is to us. He says, as I understand it, the Fed keeps and pays a 6% profit to its private member banks. The remaining 94% of the profits is paid back to the United States government. And so if the U.S. is borrowing at 2.25% from the Fed, doesn't this really mean that the effective interest rate for the U.S. borrowing is more like 0.25%? And if so, couldn't the U.S. debt be $100 trillion before it becomes unsustainable?
Well, okay, let's look at how this works. The federal government borrows money in order to fund itself. Then the central bank creates a bunch of new currency and buys the debt that the federal government is issuing. So that is functionally the same thing as the central bank just flat out monetizing the federal government, right? There's a thing called modern monetary theory that says we should just do this explicitly, where, forget about taxing people and borrowing money. Those are all just intermediate steps. And you can jump to the end step, which is the Fed creating a bunch of new currency, just finance the government that way. And in effect, that's what we're doing now. We are just monetizing the debt of the government by creating a huge amount of new currency every year. So yeah, forget about this. Oh, they pay interest to so and so, and all that really matters is the amount of new currency that they create in the system and the amount of new debt that they encourage the private sector to take on. And those two things are growing exponentially. So the new debt that the private sector is taking on leads to a crisis in the private sector when so much debt is accumulated that entities start defaulting. And the amount of currency that the central bank is creating leads to an oversupply of the currency, which causes the dollar to fall in value over time. So those are the two effects we should be looking at. The government cannot borrow infinite amounts of money because that requires the central bank to create infinite amounts of currency. So the game that we're playing, we call it a lot of different things. We look at a lot of different moving parts, but it's really just the monetization of the government. And it goes on. It works as long as we believe that the currency is valuable. If the Fed can create another $1 trillion and give it and use it to buy real stuff, in effect, hand it to people who are going to buy real stuff with it, and it works. If we can get a lot of valuable real stuff for that currency, then we can play the game for another year. But the time will come when that doesn't work because of just basic supply and demand. And it might not be the dollar that is the first currency to hit some kind of a wall, because Japan's doing the same thing, and Europe with the euro is in a lot of ways a lot more vulnerable because they don't really have a coherent financial system. They partially integrated over there, but not completely. So they've got, Italy potentially going bankrupt and leaving to, you know, go back to the lira or something like that. That's, a possibility with Europe. And it's not really a possibility that California is going to leave and go to some new currency in the US. So uh, the euro is probably more at risk than the dollar. And so what could happen is that the euro plunges because of its inherent flaws, and the dollar goes up relative to other currencies, because it's just measured relative to other currencies. They're all falling in value, but the dollar falls more slowly for a while. And everybody looks at it as this strong currency, but maybe it's only falling really by 3 or 4%. And these other currencies are falling by 6 or 7 or 8%. Um, but once people figure out that all the currencies are falling and the dollar is not stable, it's falling more slowly than the euro, maybe, but it's still falling. And so you need to behave with the dollar as if it's going down in value. And see, that's the end game out there. When that happens, then this system breaks down, but we can't know when that happens. We can't know when everybody figures this out. I would have said 2005. It should have happened already, and that it hasn't yet implies that central bank printing presses are more powerful tools than at least I thought they were for manipulating markets and fooling people. But um, banking on being able to manipulate markets and fool people forever is pretty dangerous. I don't think it's possible, and I think the consequences of all this stuff will become apparent relatively soon, and then everything changes. So, the fact that the Fed is basically, in a lot of ways, retiring the debt that it buys shouldn't be seen as this being a perpetual motion machine where we can borrow as much as we want to forever, because the borrowing really doesn't have an impact. Because it does have an impact, it's just on the value of the currency, not on the government's balance sheet and income statement. And furthermore, if interest rates were to go up anywhere else in the economy, um, let's say the US government could manage the process of higher interest rates by just having the Fed remit more money to them. But that doesn't help corporate borrowers, and it doesn't help individual borrowers. So if interest rates were to ever go up, it would bankrupt huge sections of the economy that depends on low interest rates to function. So the upshot of that is that interest rates can never go back up. We can never raise interest rates. And we found out what happens when we tried in 2018. The Fed did try to raise interest rates for a little while. And the stock market fell apart in December of 2018. And the Fed immediately backtracked and said, oh, never mind, we'll cut interest rates. And they've been doing that ever since. So that was the lesson. And, you would think to most people that would be the big lesson, right? That we can never have normal interest rates again. Therefore, money will always be excessively easy. Therefore, the downward pressure on our currencies will be unremitting. It will never end, and so why do you want to be in these currencies? Not that many people have learned that lesson yet, but I think it will be learned at some point.
Yeah, you've painted a couple of parts of the picture that I think are very compelling. One was this vision of, people have called it the bubble of everything or the everything bubble or whatever, but the way you described it, I haven't heard described before, and that was basically when everything becomes so vulnerable and so interdependent that we can't allow a failure anywhere, and then, or else it'll take everything down, and that the way to that people are being encouraged by the behavior of the system, or the incentives that are set up in that distorted system, is to participate more and more fully, to take on the risk, to take on debt and that sort of thing. In other words, that means that each individual person and each individual family becomes one of those things that can be torn apart. Their financial lives can be torn apart as part of the everything failing if anything fails. So in other words, we're being shepherded into a world where we are completely vulnerable to anything going wrong anywhere, and the only way that we have a positive long-term financial outlook for our individual and our family outlook is if these powers that be continue to squelch all problems of all kinds. Um, that's a very high risk scenario.
It is. You know, another way of putting that down again is that nothing fails until the currency fails. Because as long as your currency is perceived as valuable in the world, you can prevent anything else from failing if you're a central bank or a central government. Um, but once the currency doesn't work anymore, you can't stop anything from failing, and then everything just goes. And so yeah, you know, if you're a person, you know, an individual, you can't do anything about this. So all you can do is just try to invest wisely for the stuff that's probably coming down the road. And that means risk off to the max. You know, you want to be in sound money, which is gold and silver, own your own house debt free, pay off all your credit cards, make yourself indispensable at work. See, that's a risk averse strategy that not a lot of people follow because you know, probably the biggest financial risk of your life is being laid off, right? Because then everything else gets hard. You know, you have to start dipping into savings to cover your expenses. And one way to deal with that, and it's not a guarantee of anything, but is to figure out not just what your job is, go in and do it 8 hours a day and then leave, but to figure out what everybody needs there. You know, what do your bosses need? Not just you doing your job every day, but what makes their lives better and what makes you indispensable. So that's not an investment thesis. And usually, you know, investing is the main thing that I talk about. But, um, you know, making yourself indispensable at work, so you're the last one laid off, is huge. That's a really big deal if you can do it. And then enmeshing yourself in your community so that you got neighbors who can help you in return for the perception that you will be there to help them. That's a huge deal too, because when things get crazy, you can bet that you'll need some help, right? You will not be a fully self-sufficient, independent entity when everything around you is absolutely crazy. So these are all things you need. And you know, Chris Martenson and Adam Taggart over at Peak Prosperity run seminars on this kind of thing, where they walk you through the different aspects of your life and teach you how to be resilient in all of them. And I think that's crucial because you can invest wisely and you can make some money off of all of this, but that doesn't protect you from all the other crazy things that can happen in the world. So you know, you want to take a broad brush approach to a world that is headed for something crazy that you can't stop. And that's a huge intellectual challenge. But you know what? It's also the stuff that we should be doing anyhow. You know, all of this is just the right way to live. And to that extent, this is actually a good thing because it's putting us on the track that we should have been on anyhow.
Jerry Robinson from Follow the Money has been with us and talking about, because you mentioned one strategy that people can use is to make themselves indispensable at their employment, and no doubt by doing that they're not being entirely dependent upon that one employer, because of the skills that they learn by doing that, the life habits that they practice by doing that will serve them well if that one employer doesn't make it through. But in the one sense, that we do remain dependent. It's an element of risk to be dependent on that one employer. Or Jerry Robinson talks about having 21 streams of income, or in other words, that trying to increase your independence from that one particular employer going belly up, because that's another area where if my employer goes or does massive layoffs or whatever, then my whole life is turned upside down. So how to reduce our exposure to that concentration of risk in that one area of our lives.
You know, the other term for that is having a side hustle. You know, you got to have another thing that you do that if it needs to be close to full time, you can ramp that thing up because you have prepared the ground by doing it in a part time way. You know, and that's yeah, very useful. And you know, in the world of the gig economy, there are a lot of options for stuff like that. They're not ideal. Uber driving and my son just got a job. One of my sons as a shopper for a grocery delivery company. And so he gets orders and he goes in and packs things up for people. And that's not his full-time job. He does other stuff, but that's one thing that he has in addition to other things. And that's to the extent that you have the time and the energy for stuff like that. Um, the more you can develop, more things like that you can develop, the better off you are.
Another thing you talked about a couple of times in this interview is about people getting their hands on real money, sound money, gold and silver as primary examples of that. We have some concern from several viewers over the period of time that even people who do that are somehow going to run into pitfalls that aren't easy to foresee, either through windfall profit taxes if things do go up a lot, or this question from Jerry Long even talks about how you would even be able to sell if things like gold and silver do go up high prices in nominal values. He says, John, I have a serious question here. I'm wondering, as we approach the top of the gold silver market, whenever that is, we know the prices to be much higher. How is it ever possible for someone to get out of the physical metals? I mean, say $20,000 to $50,000 gold or $100 to $500 silver. How would it even be possible for even big name metal dealers to buy what people have for sale at a time like that?
Well, if you've got something that everybody wants, as illustrated by its really high price, then getting out of it is the easiest thing in the world. You just flip an ounce of gold to somebody in return for their car or something like that. So your gold coins are your big purchases, and your silver coins are your smaller purchases. You buy your groceries with something like that. You can go to a local farmer and buy um, a quarter of a butchered pig or something like that for a few silver coins in the kind of market that we're envisioning. Let's say silver goes to $500 an ounce, and in the crazy scenario, well, um, five silver coins are $2,500, and that doesn't mean you can buy the equivalent. Well, actually, yes, it does mean it means you can buy the equivalent of $2,500 worth of stuff today at that point in the future. So whatever that will be, however it works out, it's a lot of stuff. And so getting out, yeah, if you want to cash out and get dollars for your precious metals when things are at their craziest, you will have no shortage of people wanting to swap increasingly worthless currency to you for your precious metals. So that's not, holding on to it if people know you have it is a much scarier prospect than being able to get out of it. So, there are levels of questions that have to be answered with stuff like this. Because first of all, do you want to hold gold and silver yourself, or do you want to store it somewhere? And do you want to store it in the US, or do you want to store it overseas? And do you want to have gold and silver mining stocks as a way to generate massive capital gains while your gold and silver are holding their value, but not necessarily going up in real terms? These are all things you have to sort out. But getting out will be the easiest thing in the world. You'll be able to take stuff like that is increasing in value, and everybody knows it's increasing in value, and the fact that it's extremely expensive means people are desperate to have it. So you'll have no trouble. That won't be an issue. Just don't tell people you've got a lot of it. Don't go around complaining that you're having trouble figuring out what to do with your gold and silver, because somebody will give you a solution to that right away by relieving you of it. So you need to be very circumspect in the world that's coming when you have valuable assets that not a lot of other people have.
So far, we've been talking a lot about the system itself and how it can be held together by the actions of central banks or actions that individuals can take to protect themselves from an outcome. One thing we haven't really touched on is this connectedness of the whole thing in the financial world itself, and specifically from the regulatory and the governmental standpoint. Ronan Return asks, John, do you think the next global economic crash will be the one which will force the nations to create and accept one world currency? And do you think that currency will be purely digital form to establish complete control over the citizens of nations?
Well, that's what the guys in charge would like. There's a theory that the next crisis is actually being looked forward to by the globalization forces because they'll see it as something they can take advantage of to further integrate the global economy. Even though a lot of the political forces right now are anti-globalization, but when the crisis becomes so serious that people feel like they need strong leadership, and they're willing to put that whole constitution thing off to the side for a while, if somebody's willing to do what has to be done to stop the bleeding. When we hit that point, it's possible that the global elites will come out of their bunkers in New Zealand and fly back to Europe and the US and try to impose something like one currency for everybody and a set of, they'll do something like what Europe is trying to do, where they try to integrate all the different systems under one parliament or one prime minister or whatever. Um, and we shouldn't discount that possibility. But I think it's equally likely that we go back to something like the the classical gold standard, which was in force for 200 years before World War One, where gold was the underlying money everywhere, but each country had a currency, and that currency was just a name for a given weight of gold or silver. And in that way, countries retained sovereignty over their monetary policy and in general terms over their domestic policies. But the value of their money was determined by the fact that gold had a fixed value in terms of all the different currencies. And so you have very easy exchange in a situation like that because the underlying money is the same from country to country and continent to continent. So, it's possible that we go back to something like that if the wiser people who are making decisions at the time get to decide. That's probably what we'll go back to. And it may be that there's a cryptocurrency component to all this. It might be that something like Bitcoin is the medium of exchange because it's frictionless. It's a great thing for buying and selling at a distance. So we could see a component like that, where the dollar is basically a digital currency, but its definition is 1/10,000th of an ounce of gold. And to me, that would be a reasonable, wise kind of monetary system, um, which might be why it's unlikely, because we haven't done many reasonable, wise things in quite a while.
Nor things that establish sovereignty at the national level or at
Yeah,
the family or individual level, but
yeah,
more likely those that consolidate power in fewer and fewer hands. My wife and I just came back, as people here know, from traveling, and we were going through great difficulty with some of the security delays that we ran into, and we reflected to each other. It's like, this whole thing. Remember when we were younger and we would go pick up people at the airport or drop them off? You just walk into the airport. You could walk them down to the gate and see your grandma off, or receive that guest my parents were heavy into international relationships with different students that they had worked with over the years, that kind of thing. So we would regularly go to the airport and receive people in at the gate and that kind of thing. And realizing this whole, no matter what you believe about what happened on 9/11 or what was actually behind that, it's definitely been a change that seems irreversible so far in our culture of loss of individual liberty and increase of control over people. We definitely felt herded like cattle through gates a lot this last week, and it really, really got under our skin. So it seems hard to see what the vision you're describing of the reasonableness of a world currency based on a sound money absolutely makes sense, but a lot of things that make sense seem to be going by the wayside as each year passes, and the result seems to be an erosion of individual liberties and an increase of consolidation of power. Do you see any counter example to that, or a particular reason you think a scenario would play out where the powers that be that have been consolidating power in fewer hands would somehow lose that?
Oh, well, I think when things fall apart, the current system will be discredited in a lot of ways. People will rightly blame the currencies that collapsed and the banking systems that led to these incredibly fragile currencies collapsing. So I think it's completely possible that when we have the argument about what to do next, what to rebuild from the rubble, that there will be a lot of sound money voices. And, in today's world, you've got Brexit as an example of a reversal of the process of integration. You've got Trump, who, for all his many faults, is reasserting U.S. control over our trade policy, and populism, to the extent that that it manifests as anti-globalism, is getting more and more popular, and would, if people like that gain power in other places, would set a lot of things in motion that would be opposed to the globalization trend of the last 20 or 30 years. So yeah, I think it's completely possible that we go that way for a while. Trump is doing what he's doing, but if President Bernie Sanders is who comes next, then you'll see a lot of anti-globalization policies out of his White House. And the fact that Brexit worked, now we find out if Britain stays financially healthy, if they thrive as an independent country, then that opens the door to a lot of other European countries who want to break away and have, a free trade agreement with the EU, but not be subject to the dictates of the EU, which override what individual, what the voters of that country want to do. So, it's possible. It's like you said, it's not a good bet to expect rationality out of the world, but it's not like everybody's crazy. It's just that some ideas took hold that were that seemed reasonable for the guys in charge, but are going to turn out to be massive failures. And to the extent that we educate ourselves about why everything failed, we might have a world full of people who actually get what money is, and understand, the axiom that power corrupts, and absolute power corrupts absolutely, and might be suspicious of these supernatural or national entities that we're creating, and might not want to live under one government that controls everything. So, it's going to be a debate, basically, and there will be voices on every side of it. And you have to hope that sound money, limited government, individual freedom will be the thing that wins in the end. But I give that a 20% chance. But that's not bad. 20% means you got a shot. And so we should all be preparing ourselves to make that case when the time comes.
For those of you who are viewers of this channel, you're certainly interested in us being able to continue independently, and that's where I need to take this opportunity to remind everyone that to help us stay independent of the vulnerability to, for example, funding getting cut off at the whim of politically correct guidelines and so on at YouTube, etc., please go to patreon.com/reluctantpreppers, and for any amount, but especially if you're able to do $10 a month, you can make sure that we remain independent of the kind of censorship that can otherwise befall us. John, if people want to find out more of your work, where can they find you?
Well, I run dollarclaps.com, which covers all of this stuff on a daily basis. So the idea is go there in the morning, spend an hour, and you're pretty much caught up on the dark side of the financial world.
We've been speaking with John Rubino, and John, always appreciate you joining us here on Finance and Liberty and Reluctant Preppers.
Thanks, Dunnigan.
They say the stock market crashed today.
Yeah, I heard that.
Sounds like people's retirement accounts and savings accounts are going to get bailed into the banks.
Yeah.
Looks like pension plans and Social Security are going to get suspended too.
I know.
Sure, I'm glad we decided to put our money into gold and silver instead.
Me too.
Get your gold and silver and support this channel at goldsilver.com/?AFF=RP. Reluctant Preppers provides educational awareness and commentary only. Opinions expressed do not constitute personalized financial advice. Viewers are encouraged to do their own research and seek qualified personal financial consultation before making investment decisions.